Hello and welcome to Class 8 Personal Finance. My name is Garrett and I am not a financial advisor. I'm a truck driver. But should you talk to a financial advisor? That's the topic of today's video. This is my disclaimer. Don't sue me. I'm not a financial advisor, not licensed, anything like that. I'm just a guy on the internet with a lot of opinions and I've read up on stuff a lot. But let me give you my thoughts on financial advisors because I do have a story. In my channel 2 videos ago, I brought up this table and put it all out there about 4 good types of DIY investors because this is going to depend on the type of investor you are. After all, personal finance is personal. Let me get my face out of the way and just go screen only. We've got target date fund investor right here, which might be just a normal person who doesn't want to deal with it all but wants to have a good sound asset allocation and doesn't want to know all of the details. As I'm talking, I'm trying to figure out how to highlight this thing like I'm a professional or something. I'm not a professional. Oh, I forgot. Here we have a 3-fund index investor, and you might just be into using a 3-fund portfolio, such as a U.S. stock fund portfolio, a U.S. stock fund, an international stock fund, that is foreign stocks, and a bond portfolio, bond fund. I'm kind of misspeaking here, man. This is nuts. Well, I'm going to try to keep going. Then you have an intermediate index investor where you have someone who can go beyond the normal Bucklehead 3-fund portfolio. I'm going to put this in a different color here. So you might know how to diversify into select emerging markets and small cap value or just some factors. You might have some industry sectors in there, for example, real estate. Not a sector tilt I recommend, but it's out there. And you might be intermediate at that point. And finally, you might have a factor investor who goes really in depth. You're using the dimensional or Avantis funds. You're very heavily tilting to small and value and profitability and whatnot. And so that would be a factor investor here. What I tried to communicate in this video 2 videos ago is that this is not about how good you are as an investor. This is about how you are as an investor, your personality and your particular financial situation, your life situation could very well drive this decision on what type of DIY investor you're going to be. And by the way, these aren't even mutually exclusive categories. You can kind of be in between or whatnot. But note, I was talking about here DIY investors if you're just doing it yourself. But if you are going to hire an advisor, then this doesn't go completely out the window, but it does get influence because an advisor could tell you that you should be doing something different, and that can depend on the type of advisor you're dealing with. And by the way, not all advisors are good. And again, this is why I have a story. Let's talk about my story with this next. Specifically, let's look at this statement from the U.S. Securities and Exchange Commission, the SEC. I guess I'm going to have to fade my... No, I don't have to fade my face yet. First command to pay $12 million to settle SEC and NASD, National Association of Securities Dealers, charges involving misleading sales and investments to members of the military. The SEC today announced the institution of settled enforcement proceedings against First Command Financial Planning, a registered broker-dealer whose customer base consists almost entirely of active duty and retired U.S. military personnel. The SEC alleges that First Command used misleading sales materials to offer and sell mutual fund investments through an installment method called a systematic investment plan. The NASD today also initiated settled disciplinary proceedings against First Command based on similar allegations relating to the firm's sales of systematic plans. In settlement of these actions, First Command has agreed to pay $12 million to be used to reimburse certain members and to fund investor education programs for members of the U.S. military and their families. Isn't that very interesting? So these involved a couple of Fidelity mutual funds, and actually I was invested in one of these. It was called Fidelity Destiny 1 and Fidelity Destiny 2. I think I was in Fidelity Destiny 1, which is the ticker FDESX if you want to look it up. Eventually came Fidelity Diversified Stock Fund O later on. And there were some huge sales charges associated with this. So watch this. The systematic plans allowed investors to accumulate mutual fund shares indirectly by making fixed monthly contributions, typically ranging from $100 to $500 over a period of at least 15 years. The plans impose a unique sales charge or load that is equal to 50%. A sales charge of 50%, equal to 50% of the plan's first 12 monthly payment with no sales load thereafter. Should the military customer make all of the required payments, 180 over the 15-year period, the effective sales charge is approximately 3.3%. On the other hand, should the customer fail to make all the required payments, the effective sales charge may be substantially higher. Historically, approximately 57% of First Command's customers failed to achieve the required 180 payments, and consequently, many of them paid a substantially higher sales charge than is customary for low equity mutual fund investments. So when you're talking about actively managed mutual funds, you're talking about two major charges here. You're talking about the sales charge, which is basically the percentage that you pay when you actually invest into the mutual fund in the first place. So if you were contributing, say, $500 into this mutual fund, your account balance upon that first payment would be $250 because they took that $250 off the top. Yeah, that's pretty bad. And by the way, these plans are now illegal. But this is the company that I was with. After all, I was trying to be a responsible investor and a responsible person. I was just about to graduate from University of Arizona, and I was visiting my parents in Yuma, Arizona, off to the southwest, right near the Mexican border. And knowing that I was about to commission into the Navy, I wanted to get my finances squared away and get everything on autopilot because I was going to be on a ship and not able to manage things actively, and I want to do the responsible thing. So you look at this First Command website now, and they've got this page up. First Command responds to regulatory actions of 2004, earning your trust by putting clients first. And they've got this whole thing about how they're different now, and they're taking actions to perpetuate strong and sound business practices that reflected the highest industry standards. They even mention this word. I'm not going to make a crude joke here. This word, fiduciary duties of the board, fiduciary standard. So they're requiring all our financial advisors to become IARs, and the firm is becoming an RIA rather than a broker-dealer, I guess. So they're trying to make themselves look better. Now, are they better right now? Well, this all happened in 2004 when they made their changes. I didn't show up in their office for my own finances until 2007. Prior to that, I was, basically as a dependent of my parents. I had like these kid investments like, what are they called? The UTMA/UGMA, Uniform Transfer to Minors Act / Uniform Gifts to Minors Act. And that was basically my college fund. If I had known anything at this point about investing, I definitely would have known to stay away, because they kept my college fund in 100% stocks all the way up into college and through college. And oh, by the way, I started college in 2003, and look at some stock charts. You might see what happened in like 2004. I think my account went down by like half during college. The college fund went down by half during college. Isn't that great? Good financial planning. Yeah. Let's for one, with First Command in 2007, they still sold me whole life insurance as a single 22-year-old man going into the Navy. You don't need whole life insurance when you already have SGLI. Almost no one needs whole life insurance. I've seen some exceptions where some folks argue for it, but the answer is 99% no. It's definitely a 100% no if you're 22 years old with no dependents going into the military. You have what's called SGLI, Service Members Group Life Insurance, and that'll do just fine to pay your parents $400,000 if you croak. They also put me into an actively managed mutual fund based upon my stated preferences, and my stated preferences at the time were keep things low risk. Why? Well, because I'm responsible. I'm not trying to buy a Lamborghini. I'm just trying to, do the right thing, be responsible, disciplined, like, the military, sort of. Well, let's see how it did. They didn't put me in FDESX for this fund. They put me into FFALX. Let me see if I can find. It's now called Franklin Global Allocation A. I think at the time it was called Franklin Founding Funds, and it appears that they've recently changed the strategy on this fund. And so it's a little difficult to test this fund out fairly. Because for one, if this fund's strategy changes, then it's difficult to replicate a benchmark that's going to do the same. So it's kind of like saying, you know how if international stocks didn't do all that well and you compare with an S&P 500 fund, if this was heavily invested in international stocks and international stocks were complete duds, and I go, hey, by the way, if you had just followed Warren Buffett's advice and done an S&P 500 fund, you would have done a lot better. These guys are idiots. Well, they had no idea of knowing that international stocks are going to be duds, and so that's not a fair comparison. So I've engineered a couple of comparisons to be fair here. We've got FFALX, which is Franklin Global Allocation A. And oh, by the way, what's also not fair about this comparison is actually in my favor / in the favor of the index investor, because this fund also had a 5.75% sales charge. So they were already taking a good amount of my investments off the top before I stopped investing with them. On top of that, also the expense ratio, that part actually is their fault. Do I have the expense ratio up here? The expense ratio at the time, I want to say, was 1.25%, and it's now 1.2. That's not a substantial difference. But enough chat. I've got 3 portfolios here for the sake of fairness. I've got the Franklin Global Allocation A 100% here. I've got a do-it-yourself 80-20 global portfolio. So I have 80% stocks, 20% bonds, and those stocks are split 60-40. 60 times 80 is 48, 60 times 40 is 32. Does that make sense? No, it doesn't. Hold on. Times 80, that's why. 80 times 60 is 48%. 80 times 40 is 32%. That makes more sense in my head. And then, let me remove my face for just a moment here. You have the DIY 50-50 global portfolio here, which is 50% stocks in a 60-40 split between US and international, and 50% US bond market. The Vanguard Total International Bond Market Fund did not exist when I started investing in this. So that's one deficiency. But that probably means this other fund wasn't investing in international bonds either, because that became more of a thing later on. So here's what I did. From 2007 until 2022, this year, we're including year-to-date, so we're including January through August of this year on Portfolio Visualizer. I'm starting with a $5,000 amount, and I'm contributing $5,000 a year. That was $5,000, I think, was the limit for a Roth IRA when I started, and we're just going to keep things simple. $5,000 contributed every year from then on in. And then rebalancing every year for our Vanguard portfolios. And let's see how we did. Okay, so we've got this green line here, which is the unfair comparison, because it's a plain Jane S&P 500 index fund that did a lot better. This investor, fake Garrett, if I had just started with $5,000 contributed until 2022, I would have had $218,753. That's pretty nice payoff for $5,000 a year. If we had gone 80-20 global with 40% international stocks on the stock side, we would have had 147,168, substantially lower than that S&P 500. So, yeah, when I say the international stocks were duds, I really mean it. The DIY 50-50 global, that's like a retiree portfolio. That's like you're 50 to 70 years old. A 50-year-old, like really, really conservative investor, or a 70-year-old with maybe actually a little more conservative folks say, hey, go 60-40 in your retirement, something like that. And then you have First Command right here. With First Command Financial Planning, with this fund that they set me up with, I would have had less than the retiree portfolio made going all the way out. Chew on that. They set up a 22-year-old Garrett with a fund that did worse than a retiree 50-50 portfolio. And by the way, I even mentioned index funds to this guy. And I said, what about TSP? Because I was reading something on the Motley Fool's website at this point. I knew what an index fund was at this point, and he dissuaded me against it. Some financial advice. Good job, First Command. By the way, the particular advisor who gave this advice no longer works for First Command, so I don't want to mention his name because he might be different, and I don't want to get sued and all that. But, First Command is probably doing these kinds of same things based on online reviews. So, I'll at least go after First Command in this sense. But yeah, a retiree portfolio would have done better than First Command setting up a 22-year-old Navy ensign for success. Great job. Real financial planning for responsible people. Also, take a look at the standard deviations here. Obviously, the S&P 500, being 100% stocks, is going to have the highest standard deviation, the amount that this portfolio is going up and down. So your volatility, how many jitters you're going to have, right? Its worst year was 37% down year. Its worst drawdown month to month was greater than 50%, which sounds pretty nuts, right? I wonder if it was like this dip right over here, like at the end of 2008, that whole global financial crisis when that started. That might have been that percent. In fact, I can actually look at this. Drawdown period is based on monthly returns is November 2007 to February 2009. Drawdown recovery by August 2012. And note that's based on pure returns, not based on how much I would have been contributing in this earlier time frame. Now, the maximum drawdown in the First Command fund was from June 2007 to February 2009. It didn't recover investment-wise until later than the S&P 500. That would have been January 2013. And the drawdown was not substantially less, 49.19%. But I told them I was trying to be safe. And it definitely wasn't safe. The Vanguard 80/20 portfolio had a drawdown of 43.95. Okay, fair enough. That 20% bond allocation did its job to allay some of that drawdown to make it less painful. And then the retiree portfolio only went down 27.10% that whole time. So with a substantially smaller drawdown, like almost half the drawdown period. And that was also the global financial crisis end of 2008. And with a standard deviation of 8.41 as opposed to almost 14. That 50-50 global portfolio did better. Why was this First Command Fund, this Franklin Templeton Global Allocation A or Founding Funds thing, why did this do so poorly? And the answer is market timing. Now, they're not going to tell you, they're not going to call it market timing necessarily. They're going to call it tactical asset allocation. Because we're going to get out of the market when we know it's going to crash, and we're going to get back in when we know it's going to do well. Well, what if you get it wrong? I mean, think about it. If you try to time the market and say, okay, we're getting out, you have two things that could happen. It could go up or it could go down. So you have to get that right. And you have rough math, 50-50 chance. You get out at some point and you have a 50-50 chance of it being right. Then you have to make a decision of when to come back in. And the decision to come back in, you also have this generally a 50-50 chance of being right. So you're taking two coin flips and saying they're both going to be heads. And the chances of that are going to be 1 in 4. You're taking a 1 in 4 chance of getting it right and really benefiting yourself by market timing. And in this case, this kind of market timing did not work. If you're wondering why I have a really negative opinion of market timing, well, I would have been through it. Now, thankfully, I got out. At the beginning of 2009, I got out of it. And it wasn't really, actually, no, it was the beginning, I've corrected. It was the beginning of 2008 because the Navy sent me stateside. I was living in Japan for my first tour in the Navy. They sent me stateside to go to this, go to a schoolhouse to learn about the Combat Information Center, and that's all I can tell you about it. because I didn't learn anything. I don't remember anything. That's why I can't tell you, not because it's all classified, although it is. And while I'm going through that trip, I pick up a copy of Money Magazine. I learn what a sales charge is. I learn what an expense ratio is, and I realize I'm being kind of not treated right. And so I got out of First Command. I learned about index investing. I read the Buckles Head's Guide to Investing, and then I set out on my own. And it's a good thing I did. Hence my passion for this kind of thing, because I don't want that to happen to anyone else. Fortunately, I got out after less than a year, but a lot of folks don't. So let's keep this going. So we're going to go from here from 4 good types of DIY investors to types of financial advisors. And we can safely file First Command Financial Services under the clowns. Clowns with high fees and sales commissioned products and whole life insurance and nonsense like that. Fixed index annuities, where they try to combine annuities with stock investing. It's like, yeah, that's another video. I can't go fully into that. And so my advice, the O'Hara's take box right here, when I take my face out of it, is run, don't walk to the nearest exit. And watch out for firms that are registered as both RIAs and broker-dealers. I'm starting to discover that being an issue. RIAs are supposed to be fiduciaries. They're supposed to be acting in your best interest. And apparently First Command Financial Services claims to be a fiduciary. I have less and less confidence in that word of being fiduciary, because fiduciary means, hey, we're acting in the client's best interest. Well, I really, really thought in my heart and in my mind that, we were acting in the client's best interest and not selling them crap. Okay, the human heart can kind of do things to you, and when there's all kinds of financial incentive involved, you can fool yourself into believing that these things are good for your clients when they're really not. So let's go on. The next one, I'm actually going to go all the way up to this row here, and let's talk about advice-only registered investment advisors. An advice-only RIA will construct a plan according to your needs, but you do the moving the money around. So this is kind of the cheap way to go in terms of human advisors. Let me tell you about the controversy that revolves not around the discussion between advice only and full service. In fact, let me just give you both up front, and then we'll go from there. A full service registered investment advisor will construct and implement an independently produced plan. You've probably heard of Fisher Investments because they advertise on the radio a lot, at least around here. They've got an office, I think, in Plano or McKinney. I want to say Plano. Here in North Texas. Edelman Financial Engines is a big one. If you've heard Rick Edelman on the radio, they're a huge fee-only firm. They'll use that term a lot, fee-only. There's one firm that I've corresponded with that's of this nature, Servo Wealth Management in Oklahoma City, Oklahoma. There's a lot of full-service RIAs that will use dimensional fund advisors, and they're going to stick you into that factor investing category because they've got the factors down, and they'll target the Fama French 5-factor model for you, even though you might otherwise be a target date only investor. That's what I'm talking about in terms of these 4 good types of DIY investors and what an advisor might do. The advisor might take this guy right here, if you're one of them, and they might put your portfolio here because they're the one doing it for you. So what are the implications of that? Well, if you go by advice only, you're talking about either hourly or by the project. So again, let's go over here because I want to talk about the fee structure controversy for a moment. This advisor is Rick Ferry. He happens to be the president of the Bogle Center for Financial Literacy. He used to be compensated by percentage of AUM. AUM stands for assets under management. So you're going to hear me say AUM a bit more in this video. Assets under management, like the amount you have invested. Here's what it says. New data by Kitsis. He works for an AUM firm, Kitsis. Shows a comprehensive financial plan cost $2,500 when paid for standalone. The average AUM fee on $1 million is 1%, or $10,000 for a plan and portfolio management. Vanguard Betterment Wealthfront charge 0.25% to 0.3% for portfolio management only. 1% AUM is 100% overcharging. And perhaps it is for someone with a $1 million portfolio who's paying effectively $10,000 a year for the plan and for portfolio management. And that person with a $1 million portfolio needs to make a decision on whether he or she wants to go it alone at that asset level, or to go to someone like Rick Ferry or to John Luskin. This is another guy who goes by hourly or the plan, so he's an advice-only RIA. These guys, Rick Ferry and John Luskin, don't do the management for you. Whereas someone like a Fisher Investments, someone like an Edelman Financial Investments, a Servo Wealth Management, will take those assets under actual management, and then you're paying a percentage fee for them to do that. Let me go dig into how John Luskin does this, for example. So he says, for a one-time financial review, you pay a one-time fee, $1,725. That's it. Now, how much? Rick Ferry was pointing out that $2,500 is average, so $1,725 is actually lower than average. And Luskin continues, there are no ongoing fees, no monthly or annual subscription commitments, no assets under management billing, no commissions, just a single transparent fee for easy to understand advice. So you kind of scroll down here, and I wanted to see, I should have selected this one. I'm going to go with this one here. Mid-career household with multiple account transfers for tax-efficient investing. So I'm going to click on this one. Oh, please work. All right, and this is definitely a blue-collar fail on my part because we have this example already. Thank you for using our portfolio review services. We discussed several topics on our recent call. You're 50, married to Anita with 2 children, corporate management at biotech, schmiotech. You earn $420,000 annually. I'm not going to make $420,000 annually as a truck driver, that's for sure. And so you kind of go down here, and you've got these check boxes to say, okay, this is what you need to do. This is what you need to do. Here's your college savings plan. Here's your traditional 401k contributions, da-da-da-da-da. And it goes on for a long time. So this is what you're getting for $1,725. That is, tailored to you. It's not going to be a cookie cutter thing. Certainly there's fill in the blank kind of thing where things are generic. For example, oh, by the way, use a password management. By the way, freeze your credit. By the way, use 2-factor authentication with your financial accounts. Okay, that's not going to be customized to you. This will be. Your urgent projects are reallocating your portfolio to more conservative allocation given your retirement timeline. Your uninsured net worth solved with the placement of an umbrella policy. I need to learn about that. Your uninsured future earnings solved with the placement of a robust private disability insurance policy, and estate planning documents solved by working with an estate attorney, that kind of thing. So, is this worth $1,725 to you? Well, that's up to you, but it is cheap for a full financial plan compared to going with an AUM advisor who takes your assets under management and charges you, say, 1%. 1% is pretty much average. Here's another one. Keener Financial Planning is one here in my area. It's in Keller. I'm in North Fort Worth, so they're like a probably 20-minute drive from me. And they've got this whole fee schedule here that's a little difficult to process through, but eventually they tell you how much your project fee is based on how big it is. But the minimum fee for a general plan is $2,080. So you can count on that. I would say if you're a normal person who doesn't have a complex situation, you're working in a blue collar field, you work as a truck driver, something like that. I would expect that to be on the lower end, but that's how an advice only RIA would work in this instance. I wanted to find one more. Can they get more expensive? Yes, and this didn't scroll to the page I needed. Here it is. So this is Edelman Financial Engines. This is Rick Edelman's firm. You hear him on the radio, and he's starting to get into this weird crypto stuff. As of late, he got Soledad O'Brien to be one of the people on his radio show, which was really weird. And you can see here for your first $400,000, the annual fee is 1.75%. That's gonna end up being a lot over time. And in fact, if you understand compounding interest, then you should understand compounding costs, because you can subtract 1.75% from whatever return you expect, and it's going to be a lot. I was planning on doing that. Let's do that. So, compound interest calculator. And I'm just going to use this as an example. I'm not going to go too far into it. So let's say an initial investment, let's say $10,000. We're going to contribute $500 monthly over the period of 30 years. And let's say an estimated interest rate of 8%. And we're going to do interest rate variance range of 1. And we're going to treat that as, say, the fee. And go from there. We're going to compound annually. So for this investor, an 8% return, it would have been at $689,761. Let's zoom this in because this is a channel for viewing. I'm just going to bring this over here. There we go. That's more readable. So at 8% for this situation, you'd end up with just under $700,000 with a 1% fee. If you're paying a 1% AUM fee over that time, that means you made a 7% return, right? Which means that your final portfolio is $574. Difference between $689,000 and $574,000 is, okay, it's a significant amount. What if you had ended up with $831,000 with a 9% average return? Well, a 1% fee would have taken you down to $689,000. So 1% might not sound like a lot. It doesn't end up being 1% of the final portfolio value. It ends up being more than that. That's the way compound interest works. So be careful with going, oh, it's just 1%. It's fine. It may very well not be, but that advice that you receive for that 1% may very well be worth it, because it keeps you disciplined, because it makes sure you go through the steps. But perhaps you could have gotten that from an advice-only RIA, did the steps yourself, and then you would have saved that 1%. You would have only paid $1,725 times however many times you go back and go, hey, I want to update the plan every 3 to 5 years or something like that. Let's keep going here. So we talked about advice-only RIAs. We talked about full-service RIAs. There's another type that I have in the list, and that is brokerage-based human advisors. Here's what I wrote down. Advice services charged by the same brokerage holding your investments. These services center around the products already offered by the brokerages. So, for example, Vanguard has one called Vanguard PAS, Vanguard Personal Advisor Services. I'm going to pause here and go back here because I missed something. We're going back to full service RIAs for a moment. Recall what I said about market timing and how market timing can really destroy what you did. Market timing destroyed this First Command portfolio that they gave me, the Franklin Global Allocation A fund. They were trying to time the ups and downs of the market, and they absolutely failed. They made some really bad bets and ended up doing worse than a 50% bond, 50% stock retiree portfolio with heavily invested in international bonds that were duds. Now, when you're talking about full service RIAs, and this goes back to what I said about fiduciaries. Oh, we really thought that we were, acting in the client's best interest. We thought that this was the best thing to do. Well, what if they feel like the best thing they can do for their clients is market timing? There's a firm like this. This one here is Retirement Planners of America. They've got a big radio show. They're based out of here in Texas, but they've got offices in different places, and they've got. Can I get your face, Mr. Morafe? Let me find it. Ken Morafe, because I had his page up earlier. So they've got this radio show called Money Matters with Ken Morafe, and here's his face. And he is the financial advisor that called the 2008 stock market crash. And that's true. I guess he was with a different firm when he did, because you go to 2008, he was working as a financial advisor for New York Life Eagle Strategies LLC. So this isn't the firm that called the 2008 market crash. This is the guy who called the 2008 market crash. But here's the thing. Calling one market crash doesn't save your portfolio. You need to be consistent over time. And so remember what I said about that 25% thing? That if you try to time the market, you have to time your out and your in. And if you get it wrong, it's just not going to work. You have a 25% chance of doing that because you have two coin flips, so 50-50 chance once and a 50-50 chance the second time. Now, I obviously can't plagiarize this video here, but I'm going to leave a link in the description because this guy, Annuity Slayer, posted a video. I think it's on YouTube as well. And he does a great job outlining Morafe's moves over the year. And basically, the effect was adding an additional market crash to his clients' portfolios. And by the way, this firm, for this market timing stuff, charges 1.25% on top of whatever fees they have in the mutual funds they have. But hey, they're a fiduciary. They're acting in your best interest. And perhaps they really do believe they're acting in their client's best interest, but it's bad advice. So the advice still has to be good. If you have a lawyer who's, ethically bound, more ethically bound, because, lawyers have a long legacy of this, more ethically bound to act in their client's best interest, and they're just not good at their job, it doesn't matter. You got to find someone that's going to have a sound financial strategy. And so you've got to get educated on your own, in part, to figure out what kind of advice you need to get and avoid firms like this one. So let's go back to that list here. So I'm going to stop backtracking here. We're going to talk about brokerage-based human advisors. And I'm going to pull up Vanguard Personal Advisor Services for a moment, PAS. It'll probably come up right here just so I can kind of illustrate it for a bit. So Vanguard has two types of advice on their site. They have Personal Advisor Services, which charges 30 basis points, 0.3% per year of the assets under management. You can see that right here. So it's a pretty simple fee. Notes, it says you'll pay about $150 a year for a $50,000 portfolio, which might be the right thing for you if you're already with Vanguard. It sounds pretty good, right? Excuse me. And then there's some levels here. You need at least $50,000 to even sign up for this in the first place, but that'll give you access to an advisor, a human advisor. You basically call them once a year or maybe once a quarter. Does it say? It might be once a quarter. I don't want to say the wrong thing there. And then once you have 500,000 plus, you have a dedicated advisor that you talk to. I have some family members with this one, and they have a dedicated advisor. They know his name. He knows the family members, etc. And then 5 million plus, you have like some sort of team, I guess. But okay, you're talking about 0.30% of $5 million. Well, let's pull up the calculator. No. 0.0. 0.30% 0.30 divided by 100, which would be the percentage, times 5 million. That's $15,000 a year, which might be worth it to that $5 million portfolio family. Now, is there a disadvantage to this? Yes, because Vanguard is not going to suggest a Fidelity fund to you. They're not going to suggest a Schwab fund to you. I also suspect they don't necessarily have a good view of your outside accounts unless you're providing them your statements. And even if you do, they can't access your statements and take that money into their management for you unless you send that over to Vanguard, which you could. But if, for example, you still have a 401k and you're active in your job, you can't transfer that out of your 401k, and so Vanguard can't do that for you. That kind of thing. Fidelity has their own thing. They've got a digital advisor. Vanguard has a digital advisor that's cheaper than the personal advisor services, etc. I would say, okay, if you're going to go with one of these, you need to go with Vanguard because at least their legacy is low-cost index investing. So they're not going to lead you completely wrong in terms of investing strategy, going into weird actively managed things. Fidelity and Schwab, they're probably going to put you into higher fee actively managed funds. So I would avoid those. If you have to go with one of these, go with Vanguard. But even so, Vanguard's going to be Vanguard-centered, and they're not going to consider putting you on something outside of that. For example, if Series I savings bonds are a good solution for a problem, they're probably not going to mention it because Series I savings bonds are completely outside of their purview. So I think that's the most I can say about brokerage-based human advisors. Let's talk about robots. So, for example, Betterment. I'm going to go to this one here for Betterment, and then there was another page for Wealthfront that I should have pulled up. These are Robo Advisors. So you have these digital Robo Advisors within the brokerages, and then you have these Robo Advisors that aren't with the brokerage companies. So here's the thing. Let me go back here and make sure I've got everything that I need to say. So they are websites that charge to manage portfolios. They charge between 0.20 and 0.40% of assets. And so you've got this list here at Betterment of the portfolios they offer, and you can kind of see they're getting toyish, I'm going to say. So let's go this core one, like the normal one, right? And based on an allocation of 70% stocks, 30% bonds, they've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, up to 12 funds. Basically, if this were to become more in bonds like for a retiree, then I guess they would increase the percentages in short-term treasuries and short-term high-quality bonds. And these are all ETFs. These are ETFs you can get at your normal brokerage account and manage yourself. What's the value in this in paying 0.2 to 0.4% of your assets just to have them do these percentages for you? I don't know. Certainly there's some other things in terms of the workflow they offer, being able to talk with someone for a short period of time, I guess, but it's not going to be a full relationship like with the brokerages, and certainly not like the RIAs. But I'm really skeptical about this level of complexity, and that also brings up an issue with the full-service RIAs. The full-service RIAs could set you up with something like a 12-fund portfolio and say, hey, we need to target all of these asset classes to make sure that we really, optimize your thing. And someone like Rick Ferry would say, no, you really just need a 3-fund portfolio. And by going with the full service RIA giving you this 12-fund portfolio that you don't understand, like, I don't understand this yet. I'm gonna have to map this out and figure out, okay, how much is it in international. I can see, okay, here's developed market stocks and here's emerging market stocks. It's really heavy in emerging market stocks, which I don't like. If they wanted to simplify this, they could have just gone with Vanguard Total International Stock Index Fund and reduced the number of funds. Why are there three different value stock funds on top of total stock market? You've got 1, 2, 3, 4, 5, 6 available bond funds in here. This is nuts. This is this is a lot of complexity. And here's a Rick Ferry quote. Rick Ferry says complexity is job security. So that's what you got to worry about. Pretty much anywhere outside of the advice-only RIAs, complexity is job security. Now, that might be good because the full-service RIA could make a really good factor-based portfolio for you, and the advice-only RIA could say, look, here's how to get from being a target date fund investor or someone who's just completely clueless, like someone who isn't a good DIY investor and doesn't know what they're doing. Hey, here's a list of steps. We're going to make you a 3-fund index investor, see me in 5 years. And that might be the best way to go. Just get you educated enough to be a 3-fund index investor, and that could set you up for success. So let's go back to types of financial advisors just for a moment, and we'll try to review this out. How long have I been going? Over 45 minutes, so I'm going to close it out here in a bit. So these are types of paid financial advisors. I'm not saying these are 5 good types. No, because clowns aren't good. First Command isn't good. There's a lot of broker-dealers who fall into here. There's a lot of banks that are going to fall into here with high fees, sales commissions, etc. The correct answer to this in any situation is to run, don't walk to the nearest exit. Watch out for firms that are registered as both RIAs and broker-dealers, because then you have a conflict of interest. They can say, oh, well, we sold them that as a broker-dealer, not as an RIA, etc. You have robots such as Betterment and Wealthfront. I didn't go into the Wealthfront portfolios here. Can I find something quickly? Invest. Explore all investments. This one was a little... What's the most popular client? ARK. I mean, seriously? ARK. The ARK Innovation Fund is down 50% this year after having been basically a meme. ETF? Are you kidding me? Let's see. I need a portfolio. Oh, so you have this socially responsible thing. Direct indexing is going to be another video. I find it to be an interesting topic, but it's another video because I haven't researched it with Wealthfront yet. But even with a classic portfolio, like, hey, we're not getting fancy, we're not getting socially responsible, we're not going into crypto or tech innovation or whatnot. That's where you're just getting toyish, and it's like, okay, you're acting in your client's best things that they're interested in rather than their financial interest. And then this portfolio here, municipal bonds, emerging market stock, dividend growth stocks. Don't get me started on dividends or dividend growth. It's not a factor. And then municipal bonds. I sure hope this is not a taxable account, because you don't want municipal bonds at a taxable account. That'd be really bad. That'll threaten your license as a financial advisor. Actually, you stick municipal bonds in a taxable account, in a tax-free account, in an IRA. Ooh, bad. Hopefully, I didn't misstate that. So, robots, I just don't see the value right now, because you already have target date funds that'll do this for you, and you also have Vanguard's life strategy funds. Life strategy funds. Let me pull that up for a moment. Maybe I should have pulled that up when we talked about target date funds. Maybe I did. But let me pull it up for just a moment, because these are kind of like target date funds, but they invest either for income, conservative growth, moderate growth, or growth. And so the moderate growth fund is 60% stocks, 40% bonds, and it just maintains that same allocation and rebalances, and it's cheap. Unfortunately, their website still stinks, and so it's just 4 funds. US stocks, US bonds, international stocks, international bonds. You can understand that. A beginner can understand that. And it's 60-40. You know what you're getting into. You know the risk. You can know the risk level. And, that's the kind of simplicity that we should be promoting more rather than going to a robo advisor, paying an additional fee, and then this collection of 12 funds. And you're not going to be able to educate an investor on that. And when things get bad, you're not going to be able to help that investor to have some staying power. Because if you don't understand at least some of what's going on there, you know what I mean? So, now if you're a full service RIA, then okay, you can always call the guy and kind of go, hey, I'm scared. And the guy, convinces you to, keep going. But with a robot, what are you going to do with a robot? I mean, maybe you can call them. I don't know how well that call center is going to work when everyone's scared at the same time, because the market's going to do the same thing to everyone, right? So robots, I just don't like it. No. Brokerage-based human advisors, not optimal if you have to do one of them. Vanguard. And I say that oddly enough, as someone who left Vanguard being frustrated with their IT issues, I still think Vanguard is better than the other two in terms of a brokerage-based human advisor. Full service RIA versus advice-only RIA. If you hold up a gun to me and make me say it in 5 seconds, advice-only, period. That's all I'm going to say. The full service RIA could put you into something complex. They could put you into something completely unsound, such as this market timing nonsense. So you have to be careful with the full service RIAs and make sure you know what they're going to be doing. But it could be worth it to you over advice only in some situations. And for example, you have a situation where you really don't want to be doing the financial management. For example, I'm going to say a chronic medical condition in the family would be an example. Cognitive decline might be an example where you find a full service RIA who can kind of do this. In the case of cognitive decline, maybe you want to entrust it to a kid who knows what they're doing, and a kid who is in consultation with an advice-only RIA. That might be something where, the family kind of works things out, where it's like, okay, well, as long as you have some good advice going on and the kid isn't just doing it by themselves, that kind of situation might work. So some thought required to choose between advice-only RIA, full-service RIA, or just, doing it yourself again. You could always go to an advice-only RIA and then just not take their advice. Wouldn't be necessarily a good value, but it would keep you from being in a situation where you've got to extract yourself from a portfolio and from an arrangement that is not optimal or is taking unfair advantage of the client, taking unfair advantage of you, taking an unfair advantage of your future. So that's where I'll end it. This is Class 8 Personal Finance. I am not an advisor, but you might want to hire an advisor, or you might not. And so those are my thoughts on that. Leave a remark in the comments if you have any questions, comments, concerns, complaints, or verbal abuse. I would love to hear it. Thanks very much.